Hi there, welcome to kneppyinvests. I'm going to do another technical update video, as you can tell by the title of this particular video. Now, I did mention a few weeks ago, I won't be doing these videos every single week, which I used to do. But I sort of made a liar of myself because I keep doing these videos every single Sunday or Monday. And one of the reasons I keep doing these videos is because what's happening on the ASX, what's happening particularly on the Nasdaq is really interesting. And so in today's video, I'm going to look at the Nasdaq, have a look at a few companies on the Nasdaq because a few companies are at their all-time high, including a couple of the biggest companies in the world. And we'll also have a look at about 10 companies on the ASX whose charts are looking interesting for various reasons. Also, we'll have a look at 4 interesting tweets. Now, I like to follow people who are bearish, also like to follow people who are bullish and get a whole range of different opinions and thoughts. And I think that's a wise way to go about things, not be biased in any viewpoint, because I think it can be quite harmful if you are ultra bull or ultra bear and you really can't take aboard altering or different opinions than your own. So have a look at those 4 tweets after this first tweet from the Oklahoma Department of Wildlife Conservation, a bit of a humorous tweet. And this is an absolutely awesome organization to follow. Now, I did spend about 4 years in Oklahoma, and I found this tweet they released about 3 months ago really humorous, and people seem to like it. 4.4 million views, 143,000 likes, 14.2 thousand retweets, and it's just my sort of humor. So let's go through this. So there is a stranger, and they ask this department, is this snake poisonous? And they answer, nah, fam. Not sure what the fam is. And then the stranger picks up snake, gets bitten, starts foaming at the mouth. And the Oklahoma Department of Wildlife Conservation person says, yeah, it's venomous though. And I just like this sort of humor because there is a difference between poison and venom. For instance, poison is applied if you eat something, that sort of thing. So it's sort of, what's the word? It gets dispersed if you eat something. And a good example of poison in Australia is the cane toad. And I have seen the effects of a dog biting into a cane toad, and it is quite frightening because the foaming of the mouth is almost instantaneous. Thankfully, I knew exactly what to do. So I washed out the mouth of one of my dogs who did that almost immediately. And it frightened them, it frightened me, but after a while we knew it was okay. And venom is when they strike you and bite you. So they disperse their venom into you. And the majority of snakes, if not all snakes, are venomous. I think there might be one snake that is poisonous. So it's just the difference between the definitions of poison and venomous. This makes this particular joke funny. And seems like a lot of people agree with me. So yeah, so a little bit of humor. I've actually never brought any humor into this channel. 1.5 hours to go before Ashes starts. I just noticed there, sports trending Ashes. So make sure I'm recording this video 6:30 p.m. on Saturday. I had a few things to do. My team is playing also, but I'll watch that on delay. Parramatta Eels, by the way. Now let's go through some interesting tweets. I've got 4 here. First one is from Octavio Costa, who seems to be a little bit of a bear. He does make the point that when you compare the Nasdaq to the 10-year yield, and this is the inverted 10-year yield, they should be positively correlated here. And you can actually see that going back to the start of this period all the way through to March of this year. So the government yield was going down and the Nasdaq was going down as well. And that's, when I say going down, the yield actually going up because it's inverted here. But there has been a bit of inversion between the two's movement in the last 3 months. So the Nasdaq is actually going up, but if you do have a look at the 10-year bond yield, it's actually been going up as well, in this case going down, which is unusual to my. So he does have a point. What's going to happen now, because the Nasdaq is just on a massive tear? They should be moving in sync. So the Nasdaq should be going down, or the bond yields should be going down as well. And they're not. They're going up. And I actually did notice that. I had a look at the 10-year yields in preparation for this video, and I was shocked to see how much they've risen in a fairly short period of time. So the bond market is suggesting that they were thinking that the bond yields or the interest rates will go down in the next year, and I think they're going to have to rethink what they're thinking. That's a really bad way to put it. Unless we do go into a significant recession. So I don't mind this guy, Tavi Costa, but he is fairly biased towards the downside. He's also a really big gold bug as well, but I still follow him. Now, this one is interesting. So this is from Liz Ann Saunders, and looking at the S&P 500 P ratio and the earnings per share since about October. And what they've done is they've based it at 100. And since then, since the low in the S&P 500, it has gone up 30%. But the earnings per share is actually down or flat since that time. So what the market, and what this is showing you, the market is expecting some good earnings per share growth to justify that 30% growth. We are starting to see the earnings per share starting to grow since February or March, but we need to see significant growth from here. So the market thinks at this point in time, the bottom has been reached. Any recession is going to be short, if at all. That's the other thing, if at all. So it's going to be interesting to see what happens in regards to earnings in the next year. Fear and greed. This is from Tobias Carlisle. He tends to be bearish, but he's also a value investor. Now, the fear and greed index, this was actually a few days ago, is at extreme greed right now. And when it says extreme greed, that is a time to be a little bit wary. I would prefer it to be extreme fear, and to be extreme fear for a while. And if it was at extreme fear for a while, that is the time to go all in. So I'm a little bit wary that we are at extreme greed right now. In fact, this was June 8th, so 9 days ago. And more than likely, it's even more into extreme greed because the market has gone up a fair bit since then. And the last one is this, probably a little bit of a bullish one, I suppose. I'll just zoom in here. Stocks flourish when persistent pessimism fades. So this is a relationship between, I'm assuming, the S&P 500 and pessimism. Lower line shows the percentage of weeks in the past year with AA 11 bears greater than bulls. And every single time we have seen that reach a peak that was sort of at the recession or leading into the recession. And then we see the market go on an absolute tear when that starts to drop. So this person, Lance Roberts, is suggesting that that is now starting to fall, that pessimism, and now could be the time or the start of a really good bull run. So I don't know Lance Roberts all that well. It seems like he might be on the bull side of things. And there are quite a few bulls out there right now. So that's some interesting tweets, things to think about, because you will, particularly your own point of view, and this is the problem with humans. We have a point of view, and then we try to find the evidence to back up our point of view. We should be doing the complete opposite. Have a point of view and find evidence that counters your point of view, so maybe you can change your mind. So that's exactly what people should do, but that's exactly the opposite that people do. They try to find information that confirms their beliefs, even if those beliefs are absolutely ridiculous, like flat earths. Anyone who believes in flat earth will always try to find evidence, other people who believe them, and then we'll use that to say, hey, the earth is flat, when we all know the earth is definitely not flat. And hoping there's no one out there listening to this video who actually believes the earth is flat. That would be disturbing. Now let's have a look at the Nasdaq. Now, a beautiful chart right now. This is the very definition of an uptrend. It just keeps going higher. Even though we had a bit of a negative day on the Friday. What was it, down 0.67%? It doesn't really matter. It just keeps on going up. So the downtrend was broken back in January. And since that really was the shift in sentiment, shift in the trend. So I put in that downtrend line with the sloping downward line. It broke right here, 19th of January, and then kept going up. And there was a bit of a test, which was understandable. And then it broke through this resistance level quite strongly. And again, it tested that resistance level. Technicals work. The whole reason technicals work is sort of self-fulfilling prophecy. So that sort of thing. Now, What I'm going to show you now is maybe counter to belief that there is a relationship between interest rates and the stock market. So the belief is they're inversely correlated. And we have seen that when interest rates started to rise, we saw a lot of pressure on the stock market. And conversely, when interest rates start to drop, we should see a really good rally in the stock market. That is what that belief is really strong out there right now. And you will see that a lot of literature on this. But, and there is a but, and you'll be able to see this on the Nasdaq. So what I'm going to do now is show you a history where that didn't play out like that. And I'll get rid of this. So I've just put the Nasdaq in a line. And what I'm going to do is put interest rates on here too. We'll put it at the new price scale. So the Nasdaq is in black. Interest rates are in orange. And you can just see here. So interest rates started to rise February. And the market was looking ahead here. They were realizing interest rates were going to have to start rising soon. And that's why the stock market started to fall just before, a few months before, interest rates started to rise. Now, if we go back, maybe I should look at weekly. So let's go back to 2000. All right. Now, this might be a little bit hard to see. So leading up to the top of the bull market in 2000, the tech bubble, we were seeing interest rates rising. So it was a rising cycle. So even though interest rates were rising, stock market kept on going up. Now, the peak in the Nasdaq back then was just before the top of the stock market. And then they paused, and they paused in May of 2000. And when they paused in May of 2000, the Nasdaq went on a 33% rally because they paused. So the market was happy that they did pause because there was a little bit of weakness just before the pause, and there was a little bit of weakness because interest rates were getting too high. So the stock market was excited about the pause. So more than likely, the interest rates were going to drop in the future. And that was, and the other thing probably to keep in mind here is the expectations, and this also happened in 2008 during the GFC. The expectations were all about a soft landing, and we have heard about soft landing a lot in the past year. So they paused, the Fed paused for about, was it 6 months? Yeah, about 6 months. And then they started dropping in November 2000. And even though the stock market or the Nasdaq did rally 33%, before they started dropping interest rates, the Nasdaq started falling as well. And during the interest rate downward cycle, so the Fed was dropping interest rates, that coincided with the Nasdaq falling as well. So even though you might hear that there should be a correlation, a positive correlation or negative correlation between interest rates and the stock market, it doesn't always happen like that. In fact, a lot of times we'll see interest rates falling and the stock market falling as well. And the reason behind that has to do with recessions and the state of the economy. So if we do see a significant recession and the Fed and the central banks have to start lowering interest rates, that might be negative for the stock market, equity markets, because of the state of the economy. Now, I did predict that we won't go into recession at the start of the year. The main reason I predicted that, and I don't have much faith we won't go into recession, particularly in America, the main reason I thought that was because of employment. There are still a lot of jobs out there, and because we have a lot of people retiring, that sort of thing, there's no rise in unemployment. In fact, unemployment fell in Australia in the past month. And one of the reasons, actually, I'll backtrack a little bit. A few years ago, I said the greatest problem humanity is going to have in the future is not enough jobs for people. It won't be the problem will be we won't have enough people for the jobs. And that's going to be a significant problem in the future. But I was thinking maybe 10 or 20 years down, but we're already at that point. And this is why automation is vitally important for humanity, because we won't have enough people for the jobs. Now, the reason I'm thinking that is because of the aging population. Not only the aging population, it's also people aren't having kids anymore. And there's a lot of reasons why people aren't having kids, particularly in Western countries. It is a significant problem. And that problem is now becoming a problem in non-Western countries like Mexico, Iran. Birth rates in those countries have dropped significantly, and the only countries now that have significant birth rates are in Africa, and they are still propping up our population growth. But how long is that going to last, particularly when we educate women over there? And there is a correlation between education of women and birth rates, which is probably natural enough. Now, I haven't actually looked at 2008, so let's have a look at 2008. So we saw interest rates rising when the stock market was rising. So again, don't always believe that when interest rates rise, stock markets fall, and vice versa, because from 2004 all the way through to 2007, interest rates were rising. In fact, they rose from about 1% all the way up to 5.2%. But during that period, stock market rose a lot. And then the Fed paused in July 2006, and there was a long pause. And during that pause, the stock market, again, rose a lot. And it looked like they paused because the stock market fell a little bit in 2006, and then they paused. And then they started dropping interest rates in August 2007, and there was a correlation between dropping interest rates and the drop in the Nasdaq, fairly good correlation. And then the bottom in the Nasdaq is when they paused at the bottom at zero, almost, or just above 0%, and then they paused for a long time. And then look at this, started raising interest rates in December 2015 during a bull run in the Nasdaq. So again, don't always believe what you hear. I've heard this a lot, that because interest rates have paused and they might drop in the future, that should be really good for the stock market. Not necessarily so. So hopefully, always question stuff. That's going to be my advice. Always question stuff. Don't always believe what you hear or read. Question. It's the most important thing to do. Question. All right, but pretty bullish, the Nasdaq. So let's go through some charts, and we'll start with some Australian charts, and we'll look at the daily chart here. And the first company I want to look at is a company called Medical Developments International. They have that green whistle. Now, the reason I'm looking at this chart and paying attention is share price has been in a downtrend for a while. It keeps on dropping. Share price is currently 75 cents, around about that. Not only that, market cap of this company is 64 million. Now, they were profitable about 3 or 4 years ago, and they have seen growing revenue. Now, one of the reasons I do like this company, I do like their technology, but they're having problems in America. I don't know why Americans don't like it. Share price reached a high of almost $12 just before COVID-19. It could get back up to those levels if they start having success selling their products and become profitable. So that's the one reason I'm following this company, is because the share price and the valuation of this company is at really low levels. And I think there could be some value here eventually. So I won't take a position in this company until I see an inflection point in terms of financials. And I want to see the chart turning more positive and a shift in sentiment. But this is the sort of company I am following now. These companies have been beaten to a pulp. We'll have a look at a few more maybe. Yeah, in fact, we'll have a look. The next one is PeopleIN. Share price fell through this really strong support level about a week and a half ago. I'm pretty sure I included this company in last week's video, and the share price kept falling during the week, broke through that support level. Pretty good volume. Always look at volume. And when I see pretty big volume, and we've seen that last few trading days, that's telling me there are fund managers getting excited about where this share price of this company is right now. So this company has a market cap now of 228 million, dividend yield of 6%, price earnings ratio of 8.1, pretty good revenue growth from 2018. I can see that just in here, if you can see what I'm pointing at. So revenue has gone from 218 million to 679 million. Now, this company has really low margins, so only $17.7 million of profit. But I think the market is expecting maybe some bad news from the company. That's what the market is, and I am a little bit nervous about that. The reason I'm nervous about that, and when I say nervous, I don't really mean I'm nervous, but we saw this with DGL Group. So I put DGL Group, and I did mention this in my video yesterday. So I was following this company. So this is a company I've owned in the past. And we can see back in February through to April, looked like the share price wanted to move into an uptrend. Not a lot of volume, but it looked like the market was shifting its sentiment and the trend was trying to go more positive. But then that shift in sentiment just died away, particularly in mid-April. And then the share price just kept on falling, fell through a support level fairly easily after about 10 days of trading sideways. And there was definitely some negative sentiment around this company. So when you look at this and how the market was reacting to DGL Group, you would say that the market was expecting some bad news, and the company provided the market with that bad news the other day, and the share price fell 17% on the Thursday, the 15th of June, and a further 13.5% on the Friday. Share price currently 83 cents. And this is the why I believe you should listen to the market. The market was saying or was expecting some bad news from DGL, and the market gave us the bad news. Now, the market is not always right, and that's my thoughts, possible thoughts about PeopleIN. But the market's right a lot. And the other example I showed you in yesterday's video was AGL. Now, if you look at what's been happening with the share price of AGL since the middle of March, it's been on an absolute tear. Share price increased from about $6.80 up to $10. So conversely to GGL, the market was expecting some good news from AGL, and that's exactly what AGL gave the market on the Friday. A pretty big volume, share price up 9.7%, up to above $10. This looks pretty bullish right now. If we look at the long-term chart for AGL, it has moved into an uptrend. Last time share price was this high was way back in 2021 during this downtrend. The share price, has the potential to get up to $28. So there could be a lot more upside to AGL. So even though this has been a dog stock for a while, don't be nervous. Not nervous. Don't be overly wary about the past of this company, because they did give us some guidance for financial year 24, and it was pretty good guidance. Now, whether they hit that guidance is another question, but this is a bullish looking chart, particularly when you look at the weekly chart. Now on to Baby Bunting. So this is another company who has been under significant pressure, which is understandable, and I have put this onto my watch list. This is a weekly chart going all the way back to 2017. And the reason I want to go back far back is because the last time the share price was at these levels, $1.25 was back in 2017, 2018. It never really fell below $1.25. Now, what's been interesting when you look at Baby Bunting over the last few days, huge volume coming in when they released that negative announcement on the 6th of June, down 16.8%. Massive volume the next few days. Share price dropped to $1.25, the lows we saw back in 2017-18. And just look at the share price, what's been doing. The last 5 trading days, it's been hovering just around or below that support level. And then the last day, share price just closed above it at $1.26. So this support level is holding firm, and it's understandable because there'll be a lot of investors who know that the low, all-time low for this company is $1.25, and they see the share price right now at $1.25, even though this company is probably a bigger company, better placed than it was back 5 or 6 years ago. So that's one of the reasons I put Baby Bunting onto my watch list, just because the share price right now is hanging firm at $1.25. So I could take a position at this company at say $1.26 or $1.25, and if the share price fell to say $1.20, I'll just sell out my position. So a possible bottom, just a possible bottom, but there could be further bad news for this company, possibly. Another company that has seen a little bit of stress is Shaver Shop. And the reason I've included this company in this video is because the share price has just fallen through a support level. And the reason that's support level, actually we'll look at the weekly chart. So maybe it should be obvious. You can see the share price for Shaver Shop hit about $1.95 back in June 2021, September 2021, June 2022, and right now has just fallen through that support level. The reason that level is support is because every time the share price hit that level, we saw a bounce. Whether it will do it again, who knows? We have to wait. I would like some confirmation, maybe some good buying coming in the next few days. So have a look at the daily chart here. We haven't seen any good buying. In fact, the share price has fallen through. So if we see some high volume coming in through the next few days and the share price fall further, that will be fairly bearish. So a little bit more bearish than Baby Bunting, just because the share price is at 94.5 cents. And that, I'm going to tell you right now, that support level is 95.5, 96 cents. Now, support levels is a price, but I view it as a zone. So right now, Shaver Shop is in that zone, that support zone, just like Baby Bunting. But the downtrend is pretty strong for Shaver Shop. Another company, and I have been a shareholder of Shaver Shop in the past, and the next company, but no longer am a shareholder, Michael Hill Jewelers. And just like Baby Bunting, actually, just like Shaver Shop, the share price of this company has fallen through support. That support level is about 92.5 cents, and it's been below it now for about 6-7 trading days. So this is a confirmation of a support level broken. And just like a Shaver Shop, you can see why that's a support level. So the share price back in July 2021 got to this level and then pulled back, broke through that resistance level on strength on the 11th of October. Share price on that day rose 12.5 cents, 12.5%. That's the sort of strength you want to see. Probably would have preferred better volume. And the share price went on a nice little rally from, 93 cents all the way up to a high of $1.57 in a fairly short period of time. And then it pulled back, tested that support level in June last year, nice little bounce, and has tested it a few times in February and March, and then again in May. So it's tested this support level 3 or 4 times. In fact, 1, 2, 3, 4, 5, 6 times in the past, and has just fallen through it in the past week or so. So yeah, looks like Michael Hill Jewelers is in a downtrend. Now, Kogan. So I don't own any of the companies I've already mentioned. Now we do get to a company that I do own, and this is Kogan. Now, Kogan, the reason I've included Kogan in today's video is just where the share price closed on Friday. So the share price up 8% on Friday. But look, so I've already talked about resistance or support with Baby Bunting, Shaver Shop Group, Michael Hill's Jewelers. Now we get to a resistance zone for Kogan. And that resistance zone is around about $4, and we'll say between $4.70 and $4.80. So this is the daily chart. We saw that massive run up in share price for Kogan back in July 2022. Share price rose 50% in one day, and that was the start or the beginning or the beginning of that resistance level. And the share price pulled back. So share price again went up to that level in February this year, hit it 2 times in a short period of time, and then pulled back. And every single time, you can see this in the last 2 months, every single time share price gets above about $4.60, we do see some little bit of selling, which is just traders getting or selling out of their position because the share price is getting towards that resistance zone. And the share price on Friday closed at $4.71. So it's right in that resistance zone. If we see the share price get to say $5 and above, that will be a bullish zone, a bullish sign for Kogan, which tells us that is telling us that the market is confident about Kogan Group. And I might add to my position if I do see that zone broken over the next few weeks. I don't know if it will be. We'll have to wait to see if there's some bullish signs or confirmation of the break in that, what do you call it? Resistance zone. But really good volume as well. Some nice volume coming in the front. I'm not sure what caused that bullish day, but I do expect some good financial news from this company, and maybe that's what the market is thinking. So a little bit more excited about Kogan right now. I think we might be starting to see a possible uptrend, possible long-term uptrend in the share price. And the only thing that will affect that possible uptrend in the share price is Russell and Kogan selling more shares, which he's done plenty of times in the past. Now to a company I don't own, Objective Corp. This company has been in a downtrend since October 2021. You see the share price went to $22, and I portray that downtrend by this dashed line. Now, they did release some negative news a while back ago. I forget exactly when, but the market didn't react all that negatively to it. Now, I haven't really followed this company all that closely. I probably should have, because I actually do like this company. Still has a price-earnings ratio of 60, dividend yield of 0.94, but good revenue growth. I think this company will have good profit growth over the next 5 to 10 years as well. But that downtrend was broken on the 29th of May, so more than 2 weeks ago. So we really should have been paying attention to it. Share price went up on good strength, some good volume coming in. We did see a test Nice little drop in the share price, 9th and 10th of June, and the share price has rallied. So it looks like the downtrend in Objective Corporation has come to an end. I would have preferred the share price to fall a little bit further than this, just because I do like this company. I want to take a position, but I still think there is argument that this company is still a little bit overvalued. Now onto a company, Hansen, that is in my long-term portfolio, and we have seen a nice little rally in the share price over the past 3 or 4 weeks. It does look like the share price is wanting to move into an uptrend, but my only concern about Hansen is if you look back between November and February of last year and this year, you can see share price was in this zone for a while, which means there's a fair bit of resistance. Those shareholders bought in that period. Now, saw the share price drop after they bought, and think this company is a dog stock. But what would be helpful for this company is some good financial news. I'm not sure if that's going to come, and there's going to be a lot of resistance for this company to go higher. Consider share price. In fact, if we look at the weekly chart, so since about start of 2021, the share price has been significantly higher than what it is now. So there will be a fair bit of resistance. But when you do look at the weekly chart, you don't see a really strong uptrend in the share price, even though, and if you look at the revenue's been fairly flat the last few years. So this is a company I think can grow fairly well in the future, but it's just going through some struggles right now. Dividend yield, 2%, price earnings ratio, 29.46%. But that's because profit 2 years ago was 57 million. This year is 42 million. So if the share price or the profit was back up to, say, 60 million, the PE ratio would be probably about 16 to 18, which is probably fair value for this company. Now it's a company, IAG. A lot of insurance companies are going on runs, and this is the weekly chart. And just looking at the weekly chart, this looks pretty interesting right now. So if you go back to 2018-19, share price of IAG was at a high of $8.80. So there is that potential for this company to get back up to those levels. So this would not be a bagger. So not be 100% increase in share price from where it is now, but still 50% from here if it gets back up to those levels. That's a big if. So let's have a look at the daily chart. This is starting to look like pretty interesting. Share price, the last time the share price was this high at $5.50 was back in 2021. Now, actually, let's just put in a nice little resistance line here. And I did not plan this, but you can see back in 2021, every single time the share price got to about $5.50, and it happened once, twice, 3, 4, 5, almost 6 times, there was a lot of pressure on the share price. So it looks like the share price of IAG right now is right on that resistance level. So if we see the share price get up to 560, 570, it has broken through this resistance level, and that would be a bullish sign moving forward for IAG. Now, a lot of insurance companies, they're fairly favorable. They're favorable. I'm hearing a lot of chatter about insurance companies. So IAG, QBE, Suncorp, all those, Suncorp Insurance, I don't know. But a lot of positive chatter about insurance companies. They do benefit from high interest rates, that sort of thing. And maybe that's why the share price of IAG is almost at 3-year high. Another company I do own, and I don't own IAG, by the way, but I do own PME, which is Pro Medicus. And the reason I want to show you Pro Medicus is share price has been on the tear the last week or so, 2 weeks, and the share price is right on the all-time high. We saw the share price get up to this level back in February, and it closed right on that high. And you can see the share price for a brief period of time during the trading on Friday got above that high. There was a little bit of selling. So this could be a double top. Who knows? We want to see the share price get above this level, which is around about $6.80. $68.80, not $6. I wish the share price of this company was $6.80. P ratio of this company 135, dividend yield 0.36. So the main negative thing about Pro Medicus is just the price to earnings ratio. Not as bad as Nvidia, but still, this company needs to grow significantly over the next 5 years to justify the current valuation. And when I say grow significantly, I mean grow significantly. You'd have to probably, so last year the profit was 44 million. Current market cap of this company is 7.2 million. So even if they grow their profit by, say, 10 times, tenfold, that would still mean the P ratio will be just below 20. That just shows you how much they have to grow the profit to justify the current valuation. So I could understand why a lot of investors would not even think about taking a position in Medicus, because, in my opinion, it is swayed towards the risk instead of reward. You want to buy companies where there's a more probability of you being rewarded than not rewarded. Hence, risk, reward, swaying more towards a risk. That makes sense with Medicus, just because the valuation still growing really nice, high quality company on the ASX, the best performed company over the past 10 years. I'm doing a video series on that, growing at 60%, so returns of 60% per year over the past 10 years for shareholders. That's share price growth and dividends. Last two companies I want to show you in today's video are two companies that are all-time highs. Two companies I did take a position in, thankfully, just because I saw the share price turning into an uptrend. It was that simple. I wanted to hold these companies, and when I saw the share price move into an uptrend back in February, March of this year, I just went, yeah, I'll take a position. Yeah, and it's actually done fairly well for me. So let's have a look at Apple first. The all-time high, what used to be $182.50, which was back in late 2021, and the share price just flew through it. Now you can see on the 5th of June, it tested it and then pulled back. And then on the 12th of June, it just went straight through it. Not really strong volume. So you can see why resistance levels are fairly important. Support levels are very important because the market will test levels. And you can just see that with Apple back in the 5th of June. It tested that level, pulled back, because that's the all-time high. And investors, they know. A lot of investors know what the all-time high share price is for companies like Apple. And Microsoft, the same. I took a position in Microsoft when it broke through you can see there was a downtrend here, broke through that downtrend, and when we saw this little dip, I took a position back in March, and it's gone on 10. Now, I did not expect the share price to perform like this. So my trading for these was take a position, and if we see the share price fall a lot, I will add to my position. That was my thinking at the time I took a position in these companies, because I wasn't convinced they'll go higher from here, because, again, I'm not a bull or bear. And then let's have a look where the share price all-time high was. There it is. And the share price did go through. This is just like Apple's. So the share price did go briefly above the all-time high, and then we did see a little bit of selling in the day. And the share price actually closed below the all-time high. So the share price for Microsoft is not above the all-time high, unlike Apple. It has tested it and has pulled back. So just like Apple, the market is testing those all-time highs. Whether the share price of this company goes further higher from here, who knows? Maybe this is the top, the local top for the Nasdaq and for these companies. So really, that's all I have for today's video. If you have any questions about any companies I've looked at in today's video, time is now 7 p.m, so 1 hour to go before Ashes starts. And I'm hoping we bat for 2 days straight. I'm still wondering why they declared. I sort of understand why they declared. Was it 20 minutes before closing? Because they wanted to have a go at the Australian batsman, but that failed. They did not get a wicket. That declaration would only succeeded if they got a wicket, but they declared at a score of 398 on a fairly flat track. Although I do always say you can't determine whether a track is full of life or is a flat track until both teams have batted. So hopefully Australia is 2 or 3 for 330 at the end of play today. Anyway, if you have any questions, just leave them in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.